Hello class, this is Dr. Fenton. In this video, we are going to cover the material in Chapter 1. Now, as you can see on the screen, this material covers managerial accounting and cost concepts. There are 5 areas that we're going to cover in this chapter. First of all, assigning cost to cost objects. And a cost object can be like a unit that you're producing in the manufacturing process, or it can be a division of a company that has multiple divisions. Number 2, accounting for cost in manufacturing companies. This relates closely to number 1. And number 3, preparing financial statements. And here we're going to see that there is a new way to prepare the income statement. It's not one that's used for external reporting, but can be used for internal reporting. Number 4, predicting cost behavior in response to changes in activity. This relates to trying to decide whether a cost is variable or fixed. And finally, making decisions. And here we're going to decide if a cost or even a revenue is relevant to a decision that needs to be made. Let's talk about assigning cost to cost objects. On this page, you can see there are 2 main areas we're going to talk about: direct cost and then indirect cost. Now, direct costs are costs that can be easily and conveniently traced to a unit of product or other cost object. Examples of direct cost include direct material and direct labor, and these would be in the manufacturing environment. Indirect costs are costs that cannot be easily and conveniently traced to a unit of product or other cost object. Here, an example is manufacturing overhead. A third area, and we will not discuss this very much in this chapter or in the course, but common cost, and these are indirect costs incurred to support a number of cost objects. These costs cannot be traced to any individual cost object. What this means is that, for example, you have a company that has several divisions, and the company as a whole might spend money that benefits all of the divisions. So these are common among all the divisions. So it's a little bit past indirect cost. Of course, it's not a direct cost. Some might try to classify it as an indirect cost, but really these are called common costs. This cost benefits a variety of cost objects or divisions in the company. In the manufacturing area, there are 3 main types of cost: direct materials, direct labor, and manufacturing overhead. Now, as to direct materials, these are raw materials that become an integral part of the product, and that can be conveniently traced directly to it, to that product that you're producing. Examples would include, for example, a radio installed in a car, automobile, wood used in building a house, concrete used in pouring a driveway. So as you can see, these are the main items, the main materials included in making an item, whether it's something on the production line or a building. Direct labor. Direct labor costs are those labor costs that can be easily traced to individual units of product. So, for example, wages paid to automobile assembly line workers. These people are on the line helping, of course, the robots put the cars together, and you can see that their wages are tied directly to manufacturing those cars. The third area is manufacturing overhead. Now, this area in general is one that at first might be a little bit difficult to understand, and is one that's going to give us more, I wouldn't say trouble, but more emphasis and more work to allocate this correctly as we go through the rest of the course. So manufacturing overhead includes all manufacturing costs except direct materials and direct labor. These costs cannot be readily traced to finished products. These include indirect materials, and these can be things such as cleaning supplies, small little nuts and bolts, glue that's not very much is being used for the product. They are materials, but they're not one of the major items of material in that product. Manufacturing overhead also includes indirect labor costs. These are costs that cannot be easily or conveniently traced to specific units of product. Indirect labor costs can include items such as supervisor salaries, maintenance personnel salaries, and anyone else involved in the factory, but they are not directly working on the product, like, for example, on the assembly line itself. Other examples of manufacturing overhead include depreciation of manufacturing equipment, utility cost to run the factory machines, property taxes on the factory building, insurance premiums to cover a manufacturing facility. So only those indirect costs associated with operating the factory are included in the manufacturing overhead area. More definitions. First of all, prime cost. Prime costs, just by definition, are direct materials and direct labor. That's it. It's just a very simple definition. Conversion cost, the definition for this, direct labor and manufacturing overhead. So again, a very simple definition. Look though, direct labor is included in both of those definitions. So the prime cost will be the major items being used directly to produce a product. So direct materials and direct labor. Conversion costs are the costs incurred to take materials and convert the raw material into a finished product. So therefore direct labor and manufacturing overhead. Now non-manufacturing costs include selling costs, and these are costs necessary to secure the order and deliver the product. And these can be either direct or indirect. Examples include advertising, sales commissions, and other things like that. Administrative costs. These are all executive, organizational, and clerical costs. Administrative costs also can be either direct or indirect. Examples include salaries of administrative employees, depreciation on the assets used in the front office, and other things. So non-manufacturing costs are the selling cost and the administrative cost. Product cost. Again, another definition. Product costs include all the costs that are involved in acquiring or making a product. Product costs attach to a unit of product as it is manufactured, and they stay attached to each unit of product as long as it remains in inventory awaiting sale. So again, product cost, going back several slides if you want to, product costs are the direct materials, the direct labor, and manufacturing overhead it takes to produce a product. Again, just mention this, again, raw materials. These are materials that go into the final product. Work in process. The work in process area is where you accumulate the raw materials, also called direct materials, the direct labor, and the overhead. It accumulates in the work in process account until the product is finished, and then the product costs are transferred to the finished goods area. In fact, the finished goods inventory to remain until they've been sold. Once the units are sold, they're transferred out of finished goods into the cost of goods sold account. So again, to review that in another format, direct materials are used in production, and these are the raw materials going to a work in process. Now each set of terms I have in here that are underlined, these have their own inventory accounts. So you will see such a thing called raw materials inventory. And when you buy raw materials and before you use them in production, that's where you put the cost of the raw materials into that account. Once you start using those materials, you transfer the cost out of the raw materials inventory account into the work in process inventory account. Also, direct labor and manufacturing overhead will be transferred into the work in process account and will accumulate and remain in work in process account as the products are being worked on. Once the products are completed, their costs are transferred from the work in process inventory account to the finished goods inventory account. The cost will stay in finished goods inventory until they are sold, and then they will be transferred from finished goods into the cost of goods sold account. So again, you have various inventory accounts. They just show one on this screen, but you do have at least 3 inventory accounts in the manufacturing area. Again, those are raw materials inventory, work in process inventory, and finished goods inventory. Once the goods are sold, again, you transfer the cost out of finished goods inventory into the cost of goods sold account. So that's where the cost will leave the balance sheet and be transferred into the income statement as an expense. You saw that in your first course. Remember, when we computed gross profit, we had net sales, subtract cost of goods sold to get gross profit. That cost of goods sold number you had in the first course is the same thing we're talking about here. Period cost, when you incur these, again, these are the selling and administrative costs. They are expensed immediately straight to the income statement. They don't go through work in process or finished goods. They go straight to the income statement. Now, to predict cost behavior, what this refers to is how a cost will react to changes in the level of activity. The three most common classifications are variable cost, fixed cost, and mixed cost. Variable cost will be a cost that varies in total in direct proportion to changes in the level of activity. What does that mean? That means that the more units you produce, for example, the more direct materials you'll use. So direct materials will be a variable cost. Similarly, the more products you produce, probably the more direct labor you will use. So that cost in total will go up. Now, for our examples in this chapter, and usually throughout the rest of this course, we're going to assume that the variable cost per unit is constant. It doesn't change. So if you have raw materials that cost like $10 a unit, then the more units of raw materials you use, the total cost increases, but the per unit amount stays the same. An activity-based is a cost driver. This can be measured in units produced, machine hours, miles driven, or labor hours. Each company has its choice on what it would like to use as a cost driver. It's sort of an odd term, cost driver, but this is the item that drives the cost. So for example, if you produce more units, it's going to require more materials, more labor, and more overhead. So the unit production, the activity, is driving the cost. A fixed cost is a cost that remains constant in total regardless of changes in level of activity. So if you have like a straight line depreciation amount on your factory equipment, that straight line depreciation per year stays the same no matter how many units that you produce during the year. So the total stays the same, but the unit amount for a fixed cost per unit will decrease when you produce more units, or will increase if you produce less units. So the per unit amount does vary with a fixed cost. I know that sounds strange, but it does. But the total amount of fixed cost always stays the same, no matter what level of activity. Types of fixed cost. These can be divided into committed or discretionary. Now, committed fixed costs are long-term, and they cannot be significantly reduced in the short term. Like, for example, if you built a new wing to your factory building, that's a long-term investment. And you're not going to be able to save that cost in the short term. You built it, it's locked in. Discretionary costs are, again, fixed costs, but they can be altered in the short term. For example, you could buy or sell a certain machine. You might think it's a fixed cost. It might be fixed as you own it and use it, but you could sell it and therefore reduce the cost in the short-term basis. Now let's plot a cost line. When you look at this, you can see that we have a green line that curves. If you've taken an economics course, you've seen this line before. It's increasing at first at a decreasing rate and sort of levels off a little bit, but then starts increasing at an increasing rate. We're not going to worry about the curved lines. You'll see that in economics, but we're going to worry about the red line here. And this is a straight line for us within the relevant range. So we're going to cut off either side of that and deal with a relevant range, and we're going to assume that our, for example, cost per variable cost unit is the same. So the cost per unit is the same, so therefore we can plot a straight line for the cost within the relevant range. The relevant range of activity pertains to a fixed cost as well as variable cost. For example, assume office space is available at a rental rate of $30,000 per year in increments of 1,000 square feet. So fixed costs would increase in a step fashion at a rate of $30,000 for each additional 1,000 square feet. Let's see what this looks like on the chart. You can see from 0 to 1,000 feet, this is going to cost us $30,000. If we have to increase our area, because we just need more production area, we have to go in 1,000 square foot increments, so it jumps to 60,000. We don't have a choice to go to like 1,500 square feet. So we jump from 1,000 to 2,000 square feet. The cost jumps from $30,000 to $60,000. Let's look at some definitions again. Sort of a review. Variable cost in total, it says total variable cost increase and decrease in proportion to changes in the activity level. Per unit though, over to the right, variable cost per unit stays the same, remains constant. So that's the variable cost. Again, reviewing fixed cost. In total, the total fixed cost is not affected by changes in the activity level within the relevant range. But per unit wise, it says fixed cost per unit decreases as the activity level rises and increases as the activity level falls. A mixed cost is a cost that includes both variable and fixed. This is the line plotted. You can see that the dark, bold, straight level red line is the fixed cost portion of a cost. This is, for example, your utility bill. We're going to see an example on the next slide. So your utility bill charges you a fixed amount per month, whether you use any of the kilowatt hours or not. Once you start using kilowatt hours, then you have a variable portion that's added on top of that line, and the total mixed cost line therefore slopes up. So you have the variable cost portion that increases and the fixed cost portion that stays the same. Here's the line we will use to calculate a mixed cost. Y equals A plus BX. So in this example, Y is the total mixed cost amount, A is the total fixed cost amount, B is the variable cost per unit of activity amount, the slope of the line, and X is the level of activity, the number of units, number of hours, or something like that. Let's put some numbers to it. Let's say your fixed monthly utility charge is $40. So no matter how much you use as to kilowatt hours, they will always charge you a minimum of $40. Then you're also charged 3 cents per kilowatt hour used. And let's say your monthly activity is 2,000 kilowatt hours. What's the amount of your total utility bill? Using the formula Y equals A plus BX, let's plug in the numbers. So A, the fixed cost, is $40. We're going to add to that the total of 3 cents, that's your variable cost per unit, times number of units, 2,000 kilowatt hours. So multiply all that out and add, and we see that Y equals $100. The total amount of your utility cost for the month would be $100. That is the fixed portion plus the variable portion. Now at some point we need to use these cost classifications for decision making. And decisions, of course, involve choosing between alternatives. To help us make decisions, we need to identify those costs that are either relevant or irrelevant to the decision and then concentrate on the relevant cost. To make decisions, it is essential to have a grasp on three concepts: differential cost, sunk cost, and opportunity cost. Differential costs are the ones that differ between any two alternatives. A difference in revenue can also be discussed here, and they differ between two alternatives also. And both differential cost and revenues are always relevant to decisions, and differential costs can either be fixed or variable. Here are the definitions for some of these other important costs that we need for decision making. Sunk cost. A sunk cost is a cost that have already been incurred and cannot be changed now or in the future. It's paid for. You cannot change it. So you should ignore these costs when making decisions. Sometimes this is hard to do, but sunk costs are irrelevant to future decision making. Opportunity cost. This is the potential benefit that is given up when one alternative is selected over another. These costs are not usually found in accounting records, but must be explicitly considered in every decision. So this means you will not see a line in the income statement called opportunity cost. These are items you will need to know to help make the decision, and it'll be on your planning papers, let's say, your documentation, but you will not record opportunity cost in the financial statements. So for example, for you, what is the opportunity cost you incur by attending class? Well, you could be working, making money. That's the big thing there. Now let's go to the traditional and contribution margin formats for income statements. Over on the left, you see something that should be very familiar to you. We saw this in the first accounting course. You take sales, you take away cost of goods sold, you get gross margin. Then you take away selling administrative cost and get net operating income. And of course below that you would take away your non-operating items, add non-operating income, take away income tax, and get your net income. But this stops at the net operating income level. Now on the right you see something called the contribution format. This is sometimes called the contribution margin format, means the same thing. You still see sales, the same number, but here we have variable cost, variable expenses. As opposed to right to the left, you see cost of goods sold. On the right side of the chart here, you see that we divide our cost between variable and fixed. So we list variable expenses, subtract those. That gives us something called contribution margin, not gross margin, contribution margin. Then we take away fixed expenses, and that gives us net operating income. Another definition we're going to see in the future, contribution margin is equal to your sales minus your variable cost. So here you can see it in income statement format. Sales minus variable expenses gives you contribution margin. So we use the traditional format for external reporting, and we can use the contribution format for management within the company. We cannot use the contribution format income statement for external reporting purposes. For example, the numbers that go into the annual reports. We cannot use the contribution margin format for that purpose. What the contribution format helps us do is, we're going to see this in later chapters. Number 1, the cost volume profit analysis in chapter 5, segment reporting in chapter 6, budgeting in chapter 8, and special decisions such as pricing and make or buy analysis in chapter 12. This is the end of the chapter 1 video. Review it again if you need to, but please go back and read the chapter several times if necessary to gain a full understanding of the material included in chapter 1. So, good luck with your studies.